Now it's time for the Wall Street Beat. With 2 interest rate cuts priced into the markets, let's discuss the impact on real estate, because PIMCO expects more regional bank failures in the United States because of a, quote, very high concentration of troubled commercial real estate loans on their books. There's a sense that 2 rate cuts might not be enough to fix it. Kayne Anderson CEO Rabil joins me now. His firm has $35 billion under management. And, you know, of course, there's a lot of exuberance under the potential for at least 2 rate cuts this year. But the reality is we have seen rates go much higher in a short amount of time, and a lot of the maturities that we've seen that could come due have not yet. How ugly can things still get, even with 2 rate cuts potentially?
Things can get pretty ugly. I mean, banks have record levels of unrealized losses on their balance sheets. There's $2 trillion of real estate debt that's coming due over the next 2 years. About $1 trillion of that is on bank balance sheets. More than 20% of that is backed by traditional office. So things can get pretty ugly. We had 7,500 banks pre-GFC. We have 4,600 banks today. I'd venture a guess that we'll have 1,500 banks plus or minus 5 years from now. So I think there's going to be a lot of consolidation. I think there's going to be some pain. And I think, tangible equity is, bank balance sheets are challenged, and tangible equity is in trouble at a lot of banks today.
When you look across the real estate sector, what is kind of the hidden pain? You see the moves that are under the surface that most people don't get to see. What might show up in the next 12 months?
Well, it's just as that debt comes due and can't get paid off, banks have to figure out how to get liquidity. So we're in the middle of that. I think it presents a tremendous amount of opportunity for those of us who have capital and dry powder and who are prepared to take advantage of this dislocation. And I do think that we absolutely are. Yes, are we in a bottoming phase? Yes. But do I think there's a dislocation and a buying opportunity for the next 2 years? Absolutely.
Well, now that we have what we know today, this idea that inflation could be cooling, that rates might come down, how much do cuts start to help the market? And does it mean that we're seeing bottom right now?
Cuts are definitely going to help. I think that Jerome Powell and the Fed are smart enough to recognize that the bigger risk between price inflation and asset deflation is asset deflation, because of exactly what we've been talking about, that bank balance sheets are troubled. That said, it takes a while for rate cuts to work themselves through the market. So if Jerome Powell, I doubt that he cuts today. I said at the Milken conference last month that he would cut this month. I'm going to push that back a month. I think we're getting a rate cut in July, even though that's only a 20% probability according to the market. I think we get 2 to 3 rate cuts this year. I think we get 5 to 6 next year. I think the risk of a financial crisis and a contagion with bank failures outweighs the inflation risk. And now that he's been given some evidence that inflation has cooled, I think that he will take the step in July of reducing interest rates.
Let's talk about contagion for a minute, because that's something that people don't talk about a lot with an economy that's this strong. What becomes a bigger problem as time goes on at this level of interest rates?
Well, listen, we saw it with SVB, right? We already have greater losses in absolute dollars, SVB, Signature, First Republic, than we had during the entire GFC. So it didn't take very long. SVB, in theory, wasn't too big to fail, but it was the 24th largest bank in the U.S. That was going to be a contagion unless the Fed and the U.S. government stepped in, which they did. However, that is an easily repeatable process. And we, as I've said, many, in particular, regional bank balance sheets are in trouble today. So, in my view, Powell will want to head that off. He needed to see some evidence that inflation has cooled. He needed to show the American public that he understands the pain that they're seeing, at the gas station, at the supermarket checkout, et cetera. I think that came in today, and I think we're going to see an ease next month.
You mentioned investment opportunity, particularly in real estate. You have seen some real pain already in terms of valuations plunging in different types of real estate. Where's the greatest opportunity for you right now, whether it's in real estate or other forms of private markets?
Well, I'll address real estate. We definitely see a lot of opportunity both on the equity and debt sides of the equation. I think there is a rotation of capital that's happening into alternatives today. So we've been for a long time focused on demographically driven sectors, inelastic demand, meaning that regardless of what's happening in the macroeconomy, these sectors continue to grow. Healthcare is one of those sectors, so medical office, seniors housing, huge opportunities today. I call it the trifecta. You've got demand tailwinds because for the next 20 years you have a dramatically aging U.S. population. You have supply tailwinds because of an illiquid credit environment, and you have a buying opportunity because structural leverage doesn't work for a lot of players in the market. So you have forced selling or highly motivated selling that's happening today. So that confluence of events only happens every 10 to 15 years. The last time we saw this kind of buying opportunity was just post GFC.
What do you think about the private credit market? Because when you're saying that regional banks are still under this type of stress, a lot of your rivals have stepped into that market and said, hey, well, this is where private credit can play a role. At the same time, a lot of fear is brewing about a bubble, too much capital, too little places to invest. Where's the balance?
I think there is an opportunity in private credit, and I think the returns today are outsized relative to where they have been, normally. There is a fair amount of cushion that is provided. So, I don't think it's all going to be roses. I think, it is important who you are investing with. And certainly there are going to be some issues, in some places. But the private credit markets at, sort of at 12 to 14%, which is 200 to 400 basis points above, market norms over the last decade, plus or minus, there is a fair amount of cushion even to shield from a downturn. So I think it's an outsized opportunity set. But the word of the day is definitely caution.
Yeah, what are the mistakes that people are making right now, you think?
Well, listen, I think one of my sayings is human nature is a very strong driver. People don't want to see negative things. And so human nature tends to, it's why we want to be long, not short. It's why we want to think things are great, not troubled. But the reality is that there are a lot of warning signs out there. There's $16 trillion of consumer debt. Banks have record levels of unrealized securities losses on their balance sheets, not to mention the real estate that they have. That 16 trillion of that is 12 trillion of mortgage, 2 trillion of auto, 2 trillion of student. There are signs that the consumer is definitely strained at this point in time. I think the market is ignoring those warning signs and sort of clamoring for a rate cut. But as I've said, rate cuts take a while to work through the system.